Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. Now tonight's program, Jun Bei Liu from Tribeca Alpha Plus looks at the tech stocks that she really likes, and she tells you why these companies are quite significant and worth considering for your portfolio. And then poor Rickard looks at the recent tech rebound we've seen whenever the market's gone positive, and to see whether this was a sneak preview of what might happen down the track and what must happen for that to actually occur. And then Michael Knox, the chief economist from Morgan's in Brisbane, he looks at where interest rates are going. How high might they go? And you might not like what he has to say. That's the show for tonight. Let's kick off now with Jun Bei Liu of Tribeca Alpha Plus. Welcome, Jun Bei Liu.
Good to be here. Thank you for having me.
My pleasure. Now, you and I over the past have been willing and hoping tech stocks to make a recovery. And what we've seen, particularly last week, but in some weeks in the past as well, that as soon as Wall Street becomes positive on the stock market, generally driven by the idea that interest rates might not go as high as they might have expected, tech stocks take off and then they lose ground. Is this a sneak preview of what you expect to happen somewhere down the track?
Look, absolutely. So you're absolutely right. It's about the interest rate expectations, which now we already started seeing that stabilizing. We're seeing the inflation potentially, will be topped out pretty much, or the commodity prices falling and things means inflation not as high, interest rates sort of all expectations all priced in.
Yep.
And another thing is also when people become very bearish, which happened in the last few months, people take money out of the market. So a lot of that money actually sits in the tech stock because they've been doing so well, the market leaders for many, many years. So you're just seeing it just persistent selling in those stocks. So one is interest rate, two is that just people taking money off the table just to be more defensive. So you need, one is stabilization of interest rate expectation. Two is that when people become a little bit more optimistic about the outlook, just, recession, yeah, there might be a mild one in the US, but, it's not going to be as bad as we thought it might be. There's no stagflation, there's not all these horror terms that people used.
Yeah.
And I think these conditions are getting very close for us to get to that stabilization stage.
Yeah, so when people ask me, I'm saying, well, if you're a more of a patient long-term investor who doesn't like to lose money, you might want to wait until end of US reporting season, end of Australian reporting season, get a couple of more CPIs out of the way, both in the US and Australia. And by then the market will probably have made up its mind about whether it wants to go down a lot more or start rising.
Yeah.
Is that a pretty fair call?
Oh, absolutely. So your biggest one is we will have, so the US reporting season actually so far started okay, but there's every chance as it goes on.
This week,
yeah,
big week.
This week, and then we'll have all the consumer stocks reporting. So that's going to be a little bit tough. We already heard from a few consumer names, so that's a little bit risky. That needs to be done. Australian one needs to be done, and the next big reading in terms of US economic thing is the inflation.
Yeah.
So that inflation for July should be weaker.
Yeah.
Significantly weaker.
Yeah.
And if that's going to be the case, that will really underpin that whole expectations for the interest rates.
Yeah.
So another month, we're ready to go.
Yeah. And so therefore, are you thinking that the December quarter is probably going to be the point of time when the market will make a decision about whether it's going to go up or go down? I think that, and I think the market will go up. But as people might accuse me of being too positive. I don't know why they do that, Jun Bei Liu. But are you in my camp, or are you in the more hesitant camp?
No, I'm in your camp. I think I'm pretty positive the equity markets. People need to remember, equity market always, it's not about how we feel right now. Equity market look forward 6 to 12 to 18 months.
Yeah.
So we saw all these sell-off pretty much in the last few months. It's because we worry about recession, worry about how things will get bad, but things hasn't got bad yet. But so by the time we started feeling like things a bit tight, consumer not great, equity markets are already looking forward. So, so that means the share price already reflecting what is to come.
Yeah.
So by December quarter, I do believe that our market will do a lot better. But do be mindful that consumer stock might struggle. You know, certain sector might struggle. But generally, net, as that market definitely is stronger.
Also, the big drivers of our market ultimately are fund managers with lots of money, right? Now, there are fund managers that play a very short game, and I figure they're the ones who are most influential in the short term because they're a short game.
Absolutely, yeah.
Someone like you do buy and wait for the rotation back into the stock. You look for value when they're down.
Absolutely.
So has this been a tough year in that sense? But you're hoping or you're expecting the end of the year to be very rewarding for you.
Oh, absolutely. So this is the thing about stock markets. You don't want to invest with the herd because you know if you invest what everyone else is investing, that means you're paying too much money, or you're selling it with everyone else's. You're selling way too low in terms of price. So we always tend to be a little bit more contrarian, taking a slightly longer term view. Catalyst maybe 3 months, 6 months, 12 months down the track, but you know it's coming. Buying CSL at a certain price, you know it's a backdraw sort of thing. Buying zero at a certain price, you know it's you know your downside is limited. So you know just with those sort of stocks, you just got to buy them when it gets to a target price. Yes, last year was hard because there was so much macro, so much uncertainty coming from investors, just top down view, right, rather than bottom up. And the bottom up's been pretty good for those stocks.
We saw last week Zip which is a company historically I've liked and you liked as well. Do you think a company like that is sort of bedding down a base from which they can actually start improving from the unbelievably low price we've seen, and even though I'm not expecting anything like the $12 we once saw, do you think this company is actually trying to impress the market, and are they getting away with it?
Look, I think they're absolutely trying to impress the market. If you look at the entire fintech space, not just Zip, it's every fintech is being decimated just because money's becoming more expensive. And I think you know we always recognize this sector. They just need to go through M&A. You know, merger acquisition is very important. They need to get bigger and faster. And they're going through a challenging phase when capital is not readily available. And unfortunately, the deal with Settle didn't quite work out. But in a way, it's good because they were paying too big a price. So you know, but next checklist is really they need to align with a larger player. This sector, you know, it is maturing quite quickly, so it's very important to really get to scale.
Have you been surprised that some of the big players haven't gone along and bought these when their share price got ridiculously low?
Yeah, I'm surprised, but I think it's come from conservative. It's probably more confidence than anything else. You know, like the big banks. Why wouldn't you have bought to those guys who's fast growing and can replace a lot of your thing? I think it comes down to, you know, we all say people like to be contrarian. However, when share price falls, everyone gets nervous, right? So large institutions, especially, they will be sitting there going, "Oh, do we really want to buy this? You know, how do we explain to shareholders? What will our shareholders say?" So unfortunately, a lot of times those large companies are sitting there waiting for the bottoming in share price. So when the share price starts rallying, and they'll buy 50% higher, and they do that all the time. So that's all it is.
And so you're thinking there's a lot of tech companies out there that have probably built up good brand names, but they really do need a big buyer to come along to give them some real market grunt.
I think they just, that's right, and then just essentially align themselves with a bigger platform so they can reach out more merchants and more customers, and it's just, you need to get bigger because it's a global business. Opportunity is enormous, so you just need to get there, otherwise becomes competition will pick up, then you become a little bit irrelevant. Okay, so has any or have a few companies come on your radar screen over the last few weeks? Look, I think in terms of the opportunity, you know, so going through some of the tech names, even though have bounced quite significantly, you know, I think there's still a lot left in terms of upside. One of the names I'll talk to is, you know, Megaport. You know, we always liked Megaport. The share price was decimated because it's one of those, you know, not profitable tech, but very fast growing. And then they recently reported numbers more or less in line with expectations. Their share price up more than 25%. But however, if you look at over, you know, a few month view, share price still well down. So this is something that we thought, okay, it is actually doing really well. It's got this beautiful long-term story, and then it's hitting all the matrix now. People worry about downgrading things. It didn't happen, and it's just reached the EBITDA positive.
And it seems to me, I like tech stocks that actually have an international competitive advantage. And Megaport has that. Like they're a major player in the space that it plays. Where buy now, pay later, there's so much in it now. That's part of the problem why the share price is
So
going.
many people, exactly right. Yeah, it's exactly. Once I think I described Megaport as a Telstra of the future. No, not many people liked it, but it is becoming like an infrastructure business.
Yeah.
But it is one of the number one player around the world in getting all these big contracts.
Yeah.
And the earning is very annuity-like. So everyone who signs up, essentially just on the monthly bill, and then they only get more and more ports and get more and more services from them. So it's very stable, very predictable.
Yeah, the interesting example I was given about Megaport was take a business like the VRC in Melbourne Cup time. They don't need that capacity most weeks of the year, but over those 2 or 3 weeks of the Spring Carnival, they need a mega website. So they go and buy
all these sports.
the capacity from Megaport.
Exactly.
So that seems to me that's a good business. Another one I've come across which seems to have an international competitive advantage, I don't know if you've ever come across it before, Ordinate.
Oh yes, I like this company.
You like the company?
I do like the company. I think it surprises me. Not surprised me. It's just amazing to see Australian companies are so innovative and globally competitive. The business was really penalised by the pandemic because concerts. It's a concert.
That's right.
There's no concerts. But a few weekends ago, I took my kids to a concert. It was packed. So demand. So it is a reopening story as well as that global reach, global growth that's to come through.
Yeah. Okay. And of course, we think Xero is a similar company that its technology, its software technology is quite distinctive.
And a huge addressable market. They're opening up more markets, right? So Australia dominates, New Zealand, UK addressable market dominate that US.
One last one, and this is a company I know in the past you've liked, and I know you would have done your homework on it, and that's REA. Now, some people think REA is not going to do well because house prices are going to come off the boil. But I've heard alternative arguments saying that, well, when the house prices come off the boil, lots of people list their property to try and sell. So these sites do really well. Have you done your homework on REA and determined whether it's at a buy level or is it a wait and see?
Look, it's a buy level. So REA is probably one of the highest quality company listed in the ASX. Very high quality company.
Be it tech or non-tech?
Tech or non-tech, very high quality. It always used to be very expensive. Share price has come down a lot. Listing, okay, we'll talk about near term or we'll talk about long term. Near term listing actually turned out to be very strong. May listing was very strong. June listing was very strong. They're going to have a very good result and update. So,
which we kind of alluded to on this show. I think even Domain said the same thing.
Yeah, Domain said the same thing.
They're doing well.
So I actually think the result that's coming first week of August is going to be really strong. So share price will pop on that. Now, in terms of longer term, people will say, oh, longer term, when was the last time you experienced it? Look at GFC. So real estate listing was very, in terms of impact from GFC was quite mild. But of course, it was a fast growing company back then, penetration is low, but everything. But put that aside, that it was quite mild in terms of impact. It was down like low single digits. And then following that, where we had really hot property market post GFC, and when we had a hot property market, listing was still weak. That's because, and I think it's very true, the property just sells so quickly and they don't list as long. And so as the property market contracts a little bit, which just before pandemic, remember when pandemic hit, finally listings started turning because property market was cooling a little bit and listings suddenly become positive, and then pandemic hit and they go the other way. So I actually think there is truth to that. And given this company, it's got so many levers to pull. It's not just a volume story. It's got all the recently there's a lot of price increases through these guys as well as through Domain as well. It's a depth product, a premium product that's selling very well. So all of these will actually more to the revenue than the other side. And both of these companies, Domain and REA, they have very flexible cost in terms of operating cost. So the minute things slow and they can see us really quickly, they can pull the cost straight away. And both company has put a lot of cost in the last few years to keep up with the demand. So there's a lot of areas where they can cut very quickly. So it's an incredible business, and then there's the margin is very flexible.
I guess if someone's putting together a portfolio for the first time, REA should be there.
Absolutely, yeah.
Okay, Jun Bei Liu, thanks for joining us.
Thank you very much.
That's Jun Bei Liu of Tribeca Alpha Plus. Well, over the next 4 weeks, we've got a whole series of important data drops. And of course, US and local reporting season, but economics is going to be critically important, particularly when we look to see what the central banks do. I want to talk to Michael Knox, Chief Economist at Morgans, to see what he thinks is going to happen over the next 4 weeks. Mike, great to see you.
See you, Peter.
All right, Michael, CPI coming up this week. What kind of number are you guessing will come up?
Well, something around, I think 5.8, but something in the high five areas is what we'll have.
Yeah, but that's on the low side compared to the consensus, Michael. Consensus is around 6.3. Gee, I hope you're right.
We expected to move up, in the final quarter to just under 7%. So that's sort of a gradual ascent in that direction.
Yeah, and why 7% in the? Are you saying in the September quarter or December quarter?
In the December quarter, we think it's just below 7%. We're moving up in that direction.
Yeah, but in that time, Michael, in that time, wouldn't we expect petrol prices to come off the boil by then? And if they do, would that lower your expected number?
It could do. We'll just see how they're recorded as they go through the. There's quite a lag between where these numbers are actually recorded and how they tend to be recorded earlier in the quarter than one thinks. So that we might be sitting here with a decline in petrol prices, but they're measured earlier than in the quarter than we believe.
Okay, well let's roll into the likelihood of the central bank responding aggressively on local interest rates. Where do you suspect the cash rate will be by the end of this year?
We've said is that we think the Fed will tighten this week by 75 basis points. There's no meeting the following month for the Federal Reserve, and the month after that they'll come back from this 75% 75-point range and add 50 basis points, 250 basis points by the end of the year. But what we believe the RBA is going to do is basically get to exactly the same point of 3.35% by the end of the first week in November. That is to say, RBA will put up rates by 50 basis points at every meeting, whereas the Fed will put up rates by 75 basis points this week and then 50 basis points at the following meetings to get to exactly the same point, which is 335 basis points in the first week of November.
Yeah, I know you've always argued that the RBA watches the Fed fairly closely, and you kind of have said on this program that, Dr. Phil Lowe will probably do not exactly the same, and you're kind of implying it now. But our inflation is not as bad, Michael. Why do we have to end up the same official rate when our inflation looks like it's going to be more subdued?
Last week, we did an interview here with, we did a presentation, I guess. I was the MC of the presentation by Australian Deputy Governor last week in Brisbane. And she referred to research that had been done by the RBA a few years ago. And she observed in that she thought that the equilibrium interest rate in Australia was, in real terms, was about 1.5%. And now what I did was I found the piece that's published by in the RBA Bulletin in 2017. I noted that when actually examined the piece, what you see is that the average real rate at equilibrium in not just Australia, but also in Canada and the UK, is basis points higher than is the case in the United States. Now, people ask me, why do we have to have higher interest rates than the United States?
Yeah, good question.
And I usually reply, well, our problem is we just don't have enough aircraft carriers.
Okay, come on.
Yield than us
As one of your fellow Queenslanders would say, please explain. Come on. Aircraft carriers and interest rates. Come on.
Yeah, well, the US dollar is the international currency.
Yeah.
We used to have a gold standard back in the day. Now we've got a US dollar standard. It's where money goes to when people are scared, and the difference between the US yield and the yield of other comparable countries in the literature is called convenience yield. Okay. So their equilibrium is lower than us. We have to pay more, as do the British do, and as do the Canadians. So our equilibrium is higher. So even though when we get to the same level as the US will get to, they will be at equilibrium, but we may need to raise rates higher to get to our equilibrium. And our models say that's true, but I think that's when the difference between our inflation and the US inflation really starts to make the difference. How much extra do we need to do over where the US is when it comes to equilibrium?
All right, well, two questions, and these are questions that normal people would ask, not weirdo economists like you and me, but I'm going to ask this question anyway. Why do we have to be at the same level as the US around the same time? And secondly, you, being economists, knowing that there's going to be a big increase in repayments on home loans, if in copying the Federal Reserve and going to that equilibrium level you're talking about for interest rates, could it not cause a recession? And wouldn't Dr. Phil Lowe want to avoid that at all costs? And therefore, why not get that cash rate level at middle of next year rather than at the end of this year?
When you read the last statement and read the last paragraph of the last statement again, it's about ordinary support that was introduced during the early part of the pandemic. Now, what we know now is that the kind of reports and estimates that the RBA was reading were similar to those that were publicly provided by the Neil Ferguson from the Imperial College of London, not the economist Neil Ferguson. And they were showing that we were facing a disaster very similar to the Spanish flu pandemic. Millions would die, or at least thousands would die. And it was against that scenario that there was an international move to suddenly move rates to very, very low levels and support them quantitative easing. Now, we know now after the event that the pandemic wasn't ever that bad, but they didn't know that then, and that's why they put in this extraordinary level of low rates supported by quantitative easing. So what they're doing is they're taking that away together. So the RBA has said that's what it's doing. It's taking that extraordinary stimulus away, just as the Fed is doing it, and I think they're doing it too. Australia depends on international capital markets. We import capital most of the time, and if we move in unison with what the Fed is doing, we can limit the amount of damage we're doing to financial markets as we're doing. Then, when that's over, rates will still be very, very low by historical standards, 3 and a bit percent. Then we can go back to adjusting to our own level at 25 basis point rate hikes, which is what I think will be happening in the early part of next year.
But Michael, last week the Reserve Bank Governor said that he was sort of heading towards 2.5% on the cash rate, and he didn't necessarily have a predetermined time. He would let economic data determine it. He did say that, didn't he?
Yeah, and he said at least 2.5%.
Yeah.
But at the same time, here in Brisbane, we had this discussion of this piece that had been of research that's published by the RBA. If you can find the last piece that I wrote, I actually referred to it at the bottom of that.
Okay.
I give the reference to the 2017 article. So go and have a look at that 2017 article.
Yeah. Okay.
And it shows, as I say, that the equilibrium for the Canadians, the UK and us is 100 basis points higher than the US.
Yeah, but I don't want us to be accused of being theoretical knuckleheads, Michael, and normal people often, want to throw that kind of mud at people like you and me. But to pursue the desire to be equilibrium, could Dr. Phil Lowe put us into recession? And because it's guesswork whether it's going to cause a recession or not.
Think of the situation which is most like where we are now, earlier this century. Back in the period after financial crisis, there was an enormous amount of stimulus. There was a resources boom, just like this one, except this resources boom is bigger. Commodity prices are higher. The Australian, we've now got a really big current account surplus. We were still importing capital back then to build out the mining and gas areas. But even then, we put rates up to, we had a resources boom, a Labor government, and we put rates up to 4.75%, and we didn't have a recession period. It just didn't happen. So I think we can tolerate three. We can have a Labor government, we can have a resources boom, and we can have 3 and a bit % interest rates, which is still 1.5% lower than they were last time, and still not have a recession.
Let me throw in, just to reinforce your positivity, we didn't have $250 billion in savings accounts as well. Record levels of savings in there. Michael Knox, thanks for joining us.
Thank you, Peter.
Joining me now is Paul Rickard of the Switzer Report. Hi, Paul.
Hello, Peter.
Look, you and I have been, waiting for a tech stock recovery, and every time Wall Street gets positive, we see a pretty big rebound in tech stocks. Paul, I asked the same question of Jun Bei Liu. Is this a sneak preview of what you think might happen eventually, that there will be a rotation back into tech stocks?
Look, I think that's has happened and will continue, Peter, whenever there's good news with tech shares, and also we get a continued movement down in interest rates. But it is a bit fickle, because if you look at what happened in the Wall Street on Friday, and the report from Snap, obviously that changed the market's view about tech stocks, and we've seen a couple of the Australian tech companies get hit hard today as well. So I think sentiment is still a little fickle out there in terms of technology overall, Peter.
Yeah. Do you think what we need to see is reporting season out of the way, and a string of important data revelations from both the US and Australia before the market can determine whether it wants to go higher or go lower?
Yeah, I think reporting season is really critical. I mean, I still feel that overall we've got to get to the view that inflation has peaked, or at least people know how high it's going to be, and therefore they can believe that the central banks are doing enough to control it. I don't think the market's quite there. Maybe that view comes later this week when, we probably aren't far away in the US. Maybe we're not quite there in Australia, but I think that's still important. But certainly if you look at what's going on in the bond markets, you've got to say that the market's starting to factor in that maybe interest rates aren't going to go any higher, at least, the long part of the market, the bond market is telling us that, that's already built into the price action now.
Yeah. So you are a former bond market player, and the sentiment in the bond market can be really important for the stock market. What's your reading of what the US bond market is telling us?
Well, the US bond market classically gets things both right and wrong, Peter, and there's probably no better reader of certain things in the economy. But, you know, rightly or wrong at the moment, the bond market is certainly worried about economic growth. And so I'm not necessarily a huge fan of the argument that, you know, the curve changing shape is automatically a predictor of recession. But I do think the bond market, the steep drop we saw in bond yields last Thursday and Friday, is on the back of data showing that the US economy appears to be slowing, and perhaps starting to say that, well, the central banks are taking rates far enough and they'll take them high enough that this will cause some impact on economic growth. So that's what I think the bond market is saying at the moment, probably more along the lines that, we've got enough short-term interest rate increases already built into the equation. And by the time the central banks follow through on those actions, the economy will already slowed a little bit, and maybe inflation will be under control.
And so the meeting this week of the US Federal Reserve, the FOMC meeting, that's going to be important in terms of what kind of comments, observations and forecasts come out of that meeting, right?
Yeah, I mean, I think it is going to be important in that respect, Peter. So particularly how the bank is looking at things going forward, I think that's going to be really important. And so the bond market will read a lot into that. But you got to say the bond market at the moment is actually, you know, we've got US 10-year bond yields below 2.8%. They got almost about 3.4%, you know, a few weeks back. So it's actually been a big movement down in yields that I think it's easy to lose sight of, in the sense that the bond market is saying, okay, we think interest rates, all this action in interest rates is already fully priced in. The next move down is, if anything, and this is the bond market looking way, way, way out to the future, is interest rates heading down again. Yeah.
And it's interesting, Paul, they were wrong when they took the long bond up to 3.4 because they thought inflation was going to be terrible and the interest rates are going unbelievably high. And now they're going the other side. So they could be wrong on the recession story. It may well just be a slowdown in the US.
Yeah, I mean, look, the bond market, they like to think they're right, but their record is about 50-50, no better than anyone else's. They're just a little more...
vocal.
What's the right way to describe it? But anyhow, they're not as... They like to think they're a bit smarter than most people, but so do bond traders and fixed interest fund managers. So, look, their record's no much better than anyone else's, put it that way. So I think there's no, I'm not saying they're going to be right, but I think that it is a big movement down, and does tell you at least, I think, that probably all the interest rate increases are already priced into the market enough for people to think that they're actually going to start to work. And so, as I said, the next course, this could be some years down the track, is the central bank saying, hang on, we've done enough tightening, now it's time to be thinking about sort of almost easing off again. That's what the bond market is telling you.
Yeah, okay. Paul, we've seen some tech stocks start to really show some positive signs. They tend to be ones that have competitive edges, like the megaports and people like that. But also a company like Magellan, you and I in the boom, doom and zoom have been debating whether $11.90 or $12 or so is the bottom for Magellan. It seemed to have a good week last week. Do you think, and it actually reported better investment returns, didn't it?
Yeah, look, it showed its. I've always argued that with some of those fund managers, Peter, the money follows the performance. So the key driver is how the fund is doing relative to its competitors in the markets. Yeah. And Magellan went through a period of for the first decade or decade and a half of its existence, it was a chronic outperformer. And then in the last couple of years, it's lost its edge a little bit, and that's what started to see the funds flow turn around the other way, and we saw the big movement out from one of the institutional managers or institutional clients, and then we've seen retail clients also taking money out in the last 18 months or so. And that's why the market's got so bearish on Magellan. And so I've argued that the funds flow comes as a consequence of performance. What you really look at is how it's going on the investment side. And if anything, the last couple of months have been better for Magellan. So although everyone did it tough in June, Magellan's June performance was relatively better than many others. And so some of the, when we saw when the investment management team changed early in the year, I think some of those things that they've put in place might be starting to pay off. So if you get another couple of months of strong performance from Magellan, I think you'll start to see the funds outflow will stop, and suddenly the market will find a reason to start to buy Magellan shares again.
So in many ways, Paul, we are in this sort of an unusual, well, it's a situation we don't see very often, that lots of really decent companies of the future have been really sold off, and it's probably a buying opportunity to get in now, but you might get in now and then find in 2 weeks or 3 weeks' time there's another sell-off, but maybe in a year's time you'd be really happy that you bought in then. Do you think that's the case for many of these quality tech stocks? No, we always say Xero is one of those, REA is another one, but there's Megaport's probably another one. But it is an interesting time for people wondering whether they should have a crack right now or wait till 2 reporting seasons, American, Australians out of the way, and maybe another month's worth of inflation.
Yeah, look, I think this is an interesting period in markets. We're doing, we're stabilising, sort of finding a bottom, question mark, and I think this is a part of the time in the market just to be a little bit wary of, because I think it's still not clear whether, we're heading one way or the other just yet, Peter. So I think there's value in tech stocks, but I think that the re-rating is, what caused the tech stock challenge up front in terms of interest rates is probably now off the boil. But now what people are going to worry about is the impact of a slowing economy and what that means for consumer demand, and ultimately what that means for the demand for some of these stocks or demand for some of their products and services. So I think we're still on the sidelines a bit here. There's been some of the stocks need to recover. They were so oversold. I think it's the great core tech stocks are still worth holding in the portfolio, but I think you're going to look for big gains. I think still the market's got to do a lot more work yet.
Yeah. I was just thinking as I was listening to you that even if a recession came in the US and people lost their job, I still reckon they'll hold their Netflix accounts before they stop buying other stuff. They'll stop buying other stuff before their Netflix account, because they're going to be home doing nothing, so they have to watch their Netflix.
Yeah, that's right. I mean, and that was one of the concerning things I think about the Snap data on Friday. Snap's not that important, but it did talk about reduced advertising sales. In other words, advertisers aren't spending as much through social media and so forth, and that's I think took an impact on some of the other major tech platforms.
Yeah. All right, mate. Thanks for joining us.
Thanks, Peter.
That's Paul Rickard of the Switzer Report. And that's the show for tonight. Thanks for joining us. Don't forget we're back on Thursday. If you want to know more about us, go to switzerreport.com.au. Thanks again for joining us. I'm Peter Switzer.